Inflation affects every corner of our economy, and importantly, the prices we pay for goods and services. But have you ever wondered how people's expectations about inflation can influence the actual inflation rate itself? Welcome to the fascinating world of the psychology of inflation. At its core, inflation is about rising prices, but these price changes are not just dictated by cold, hard numbers. They're heavily influenced by human perceptions and expectations. When consumers expect prices to rise, they often act in ways that actually contribute to inflation. Imagine this. When you anticipate that the price of milk will rise next week, you might stock up today, increasing demand and inadvertently nudging prices higher now. Businesses, noticing these patterns, may increase prices proactively, contributing to the inflationary cycle. This anticipatory behavior is at the heart of the inflation expectation nexus. But why do people have these expectations? Often, past experiences with inflation play a crucial role. If inflation was high last year, consumers and businesses might expect similar trends to continue, even if current economic indicators suggest otherwise. This psychological anchoring can create a self-fulfilling prophecy. Central banks are acutely aware of this phenomenon. Through communication strategies, they seek to manage and shape public expectations about future inflation. By doing so, they hope to anchor inflation expectations firmly, thereby stabilizing actual inflation rates. However, when central banks fail to gauge public sentiment accurately, or when external shocks occur, these expectations can go awry, leading to volatile price movements. To complicate matters further, the media plays a significant role in shaping public perception. Headlines announcing rising prices or a looming inflation crisis can heighten public anxiety and prompt actions that drive real inflation. So, what can we do as consumers? The answer lies in staying informed. By understanding the factors that drive inflation and by recognizing the psychological elements at play, consumers can make more rational decisions that don't inadvertently exacerbate inflationary pressures. In conclusion, while prices are driven by supply and demand fundamentals, the human element, our expectations and behaviors, plays a vital role. By being aware of how our perceptions shape reality, we take the first step towards a more balanced and informed economic outlook.